Good morning and welcome to the Money Control live stream. You're watching Markets with Santo and CJ. Well, Santo, a handful of earnings, big earnings over the weekend. But for me, I think the biggest story that emerged from this weekend of, mega earnings that we saw is the fact that Kotak Mahindra Bank, in my opinion, is coming after ICICI Bank's dominance in loan growth, Santo.
Go ahead, CJ. I know you've always been a big fan,
look at the
cheerleader
numbers
for this stock.
Yeah, I mean, look at the numbers, man. I think it just clearly seems that basically after a 2-year hibernation, Kotak Mahindra Bank, the growth engines there are totally turning, and it's finally joining the party that a lot of people have been talking about in the banking sector. I mean, loans grew a mind-blowing 29% on a year-on-year basis, basically leaving behind everybody else, including ICICI Bank, which had a growth of about 21% on a year-on-year basis. The good part, I think, what actually shows the aggression that Kotak Bank is showing is the fact that unsecured retail credit, which is basically your consumer durable loans and your credit card loans and all that, that grew a whopping 77% on a year-on-year basis. Yes, of course, the base of the year-ago quarter is low, but even if you adjust for that, this is quite a spectacular growth number that we are, looking at. And I mean, I think this feeling is also being, represented by what Morgan Stanley had to say in their note today in the morning. They are suggesting that the Q1 print is basically showing that potential for positive earnings surprises going ahead is now rising for Kotak. So I think if you're looking at those two banks, probably my bet right now would be on Kotak.
Well, CJ, I take some of the points you made there, especially the growth in unsecured retail credit and all that, the bank getting more aggressive. But it's not strictly fair to compare Kotak Mahindra Bank's growth with that of ICICI Bank's loan growth here. You're talking about almost a 9 lakh crore loan book here for ICICI. The base makes a huge difference there. Kotak Bank, the base is much smaller. So I don't think a direct loan growth comparison would be the right thing. That said, Kotak Bank, there were chinks in the bank's latest first quarter earning. For instance, slippages have almost doubled, CJ. There's no getting away from that. And besides that, there was a huge treasury loss as well. Operating profits were also down significantly. It's missed estimates, in fact, and your CASA ratio is the lowest in 7 quarters.
True, Santo. I think deposit is one side of the game where I think Kotak has been suffering a little bit. But I think if you go by what analysts have to say, Kotak does not really need to depend too much on deposits to ramp up its loan growth. And I think deposit is something that will come back over the next coming quarter. I think that is the belief out there in the market. But for me, I think the reason why I talk about Kotak is because Kotak, along with, of course, your old favorite HDFC Bank, has been among the underperformers in the banking space over the past 1.5 years. Now, clearly the argument was that, corporate loan focused lenders would be doing well, the capex story is coming, so therefore you should be focusing there. Plus, Uday Kotak was so, circumspect and cautious even when the second wave ended. When other banks were ramping up loan growth, Uday Kotak wanted to stick to his guns and remain cautious, right? Now he has turned optimistic. And ICICI Bank has had a great run. And therefore, for me, I think the upside seems a little limited on ICICI Bank compared to a Kotak Bank. And you talk about slippages, Santo. Yes, there has been a Q-on-Q increase in slippages, but let's not forget that I think probably after HDFC Bank, Kotak Bank has the best risk assessment, abilities or capabilities in this sector. And the client base is something that you want to bet on. So for me, Kotak is one bank that will probably not sacrifice asset quality at the altar of growth, as maybe ICICI Bank has done in the past.
No, see, ICICI Bank under the new boss, Sandeep Bakshi, there's been a huge sea change. They are now looking largely at profitability, profitable growth. That's been the mantra for some time now, which is now reflecting in ICICI Bank's numbers also. Besides that, just look at the first quarter numbers. Net interest margin is at an all-time high of 4.01. Loan growth is at 21%, has been the highest in almost 21 quarters. Besides that, look at the gross and net non-performing asset ratios. Both of them are the lowest in 30 quarters. Okay, restructuring book is down by about close to 11%. And lastly, recoveries and upgrades have also been up about 16%. All this is now again reflecting in the stock price as well. If you see, there's been a couple of correction, but the stock has managed to bounce back very strongly. Compare this with Kotak Mahindra Bank, the stock is still nowhere close to the highs it had made in October last year.
That is true, exactly, and that is my point, Santo. That is what I'm trying to say, that those numbers tell me a story that is reaching its peak, right? Whereas Kotak is nowhere near its peak, is actually making that upward bend. So for me, that is why if you're looking for delta in the market, maybe Kotak is the place to be rather than ICICI Bank, not taking anything away from the spectacular numbers of ICICI Bank.
Well, let's look at the market, CJ.
Yes, Santo, before we move on to other stocks, let's quickly take a check of the market, and clearly it's going to be a very muted start this morning. The exchange Nifty is indicating a moderately negative start for Dalal Street. If you look at the cues from Wall Street on Friday, they were also not that great. Both the S&P and Nasdaq as well as the Dow Jones also ended in the red after a weak, economic print, couple of economic data. Apart from that, well, FPI threw a googly on everybody. After almost 3 to 4 days of net buying, they were actually net sellers of more than 600 crores on Friday. So clearly, I mean, if you were going to read a lot into that FPI buying, now you are stumped.
Well, if you look at most of the leading reports in today's business papers, it's largely assessment of the quarterly numbers announced so far. And one thing is coming out very clearly is that the pressure on margins because of inflation is now beginning to reflect. Although we have not seen any major cuts in earnings estimates, there's been price target downgrades very clearly.
I think probably, Santo, that is one reason for that might be the fact that everybody was expecting it. It's not a new story, right?
And also, I think it looks like everyone is looking too far out into the future also perhaps. But that said, there's been no consistency in FI activity. They were buyers for about 2 or 3 days, and then again they turned net sellers. So my guess is that maybe market could slip into a consolidation.
I think, Santo, the only solace for bulls would be the fact that in the FNO segment, at least the cues from FIIs were quite positive. That said, I mean, we'll have to wait and see how the day develops for the market, but there are a few more stocks that are on our radar, Santo.
Well, JSW Steel, the company announced its first quarter numbers over the weekend. Again, as only to be expected, the numbers were not all that great.
Yeah,
in fact, it has at the EBITDA level, it has missed analyst estimate also. Now, according to CLSA, one of the worrying things, CLSA has a sell rating on the company. According to CLSA, the company has not given any guidance for iron ore realization, and Nomura is of the view that the pressure on profitability which was seen during the first quarter is likely to persist in the second quarter also. And lastly, we have a negative kind of call from Citi also, where it has said that among other steel stocks, if you compare JSW to, the valuations don't give much comfort. In fact, the upsides could be higher in some of the other steel stocks which have corrected.
I think, Santo, probably one of the reasons for that is that maybe compared to Tata Steel and SAIL out there, or Jindal Steel even out there, I think JSW Steel's correction was much milder compared to the other 3 stocks, and I think that is why probably the potential for upside might be limited. But that said, I think, when you talk about the margin pressure, I mean, that has been a dominant story in the steel sector. Clearly, I think Q2 probably would be the worst of it. All hopes are on the government that probably it will roll back some of the, the export duties that it had imposed on steel sector. I mean, JSW Steel's management, which recently gave an interview to many publications, they iterated the fact that they have made their case to the government, and the government has suggested that it is only a short-term thing. So if that reverses, I think there could be some potential upside from there. Apart from the fact, the commentary from the management was quite interesting. I mean, from their commentary, I implied or inferred that probably, the pricing in the international market might be bottoming out at this point of time. Of course, Europe remains a big risk, but China, on the other hand, could be doing the heavy lifting going ahead. Clearly, production in China has fallen while demand has risen, which could be supportive for international prices. And I think overall, second half of FY23 will be all about China and will be all about exports. If we see that big stimulus in China doing its thing, and we see, the construction sector demand there rising, clearly companies like JSW Steel could see a revival not only in margins as well as volumes in FY23. That said, another big bang earnings that came in yesterday, on a Sunday evening, was Infosys. Well, and it was quite a surprising number. I mean, people were fearing that, Infosys is doing earnings so late, and on a Sunday, probably there is a lot of bad news. But in fact, there was some bit of good news there for investors, as the company has surprisingly raised its FY23 growth guidance to 14 to 16% from 13 to 15%. Now, we know the commentary that, TCS had, Santo, and you had highlighted it, how they appeared a little limited and very cautious. But Infosys, nothing like that. They're talking about market share gains. They're talking about probably the strongest deal pipeline that they have seen in a long while. And I think what Infosys is trying to tell investors here is the fact that we are better than everybody else at this point of time. In this cycle, maybe no other company will give you the growth that we can give, and the risk reward clearly are quite favorable. I mean, the valuations have corrected quite a lot.
Well, CJ, I think the big worry for market at this point in time is largely the margin. The big worry there is margins. If you look at revenue growth, I mean, revenue could grow well, but what if your margins continue to be under pressure? That means that profitability will.
But they have also retained the guidance on margin at 21 to 23, which goes to show that probably the worst is already seen.
Maybe. I think what the market thinks is that it's still an assumption at this stage, right? So they are not very convinced. It's been the case with TCS also. Analysts somehow don't seem to be convinced that the order pipeline is likely to be strong beyond FY23. Already, if you look at the economic data coming in from US, there's already been signs of softness in the services sector, which is actually contracted last month.
But
after
at
a long
the same
time,
time, new services order actually rose quite sharply. So there is nuance there. I mean, there is
nuance there. But if you purely go by the price, how market is looking at tech stocks at this point in time is that they are not very sanguine about the demand prospect. Maybe they may change the view in a couple of quarters, but for now they're treating every number.
I guess managements will have to prove the analysts wrong, I think, at the end of the day.
And Yes Bank, the last stock on my watch list, operating profit down 36%, slippages up 25%, and NIM also declined marginally. A fairly disappointing set of numbers. The stock has flatlined for a while now.
Well, that said, Santo, let's just quickly look at the market, the opening bell, and it is clearly a muted start. If you look at the Nifty and Sensex, Nifty is down about 0.3%. The Sensex is also down about 0.3%, Santo.
Well, that it does look like the weakness could persist today.
Yeah, I mean, I think the advanced decline is also quite weak. Actually, quite strong. I mean, it is probably thanks to small cap stocks, because about 1,200 stocks are advancing, while around 600 to 700 stocks are on the declining side.
Nifty mid cap is flat at this point. Nifty Bank is up slightly.
Yes.
I think, CJ, it does look like the market is seriously lacking triggers at this point in time.
Yeah, I mean, Santo, I think probably macro probably has been sidelined at this point of time, given that we are now in the earnings, at the thick of the earnings season, and stock specific moves probably would be more, heavy on investor sentiment as well as on the indexes as well, because I mean, look at today, you have almost 31% of the index, coming out with its earnings since Friday evening till Sunday evening. So I mean, there will be a lot of push and pull in the index, and let's see how and where we end up this month, because let's not forget that later this week we have the expiry, and there are almost 4 to 5 Nifty earnings that day as well.
Well,
yeah, coming back to Yes Bank, Santo. I mean, you talked about. I mean, yes, I understand that some of the internals of the lenders were not looking that great. But for me, I think Yes Bank, you have to keep those internals or the nitty-gritties aside and look at the larger story. Now, what is the larger story at Yes Bank? This is clearly a lender that is on a mending path, right? It is on a revival path, and I think the new deal with the ARC, formation of the ARC, the new arm that they have set up, I think that could possibly boost growth going ahead, because with the NPAs now being taken off their book, it will free up a lot of capital for the bank to probably start lending operations on a higher scale. Apart from that, a new managing director and new managing director and CEO is coming into the bank. Now he's coming in at a time when, of course, the asset quality issues seems to have been largely taken care of. So probably his focus could be more on growing the bank, growing the deposit base, growing the loan book as well. And one thing that stood out for me from the earnings is that the Q1 deposit growth for Yes Bank at about 18% year on year was better than ICICI Bank and Kotak, which goes to show that probably customer faith and customer belief is also returning for Yes Bank. And I think those are the good signs that I will try to focus on.
Not reflecting in the stock price so far, CJ.
Well, that is true. I know, Santo, at this point of time, it seems like we are at the bottom of the scale. But, probably that is also because the pain that a lot of investors had who bought Yes Bank at 200, 250, 150 and believe that there will be revival soon. So clearly, skeptics are there. But sometimes having skeptics is also great for the bull story. That's it, Santo. I think one of our guests, viewers actually, Abhishek Ranjan, has been asking us about price to equity. You and I were also talking about that in terms of IT stocks. Is PE really important?
Well, it again depends on the sector you're looking at. So if you're looking at bank stocks, then PE is not the best parameter. Banks, absolutely. Insurance, any financial sector for that matter. There, it's for instance, for insurance, it will be more on the new business premium. Yes. For banks and NBFCs, it will be price to book. That's the parameter. But for most of the sectors, on the whole, PE is the main benchmark, but there again, it's pretty nuanced. I mean, your textbooks would tell you that buy at low P and sell at high P, but it doesn't work that way across all sectors. So, for instance, typically if you look at the commodity sector, you tend to make more money when you're buying when the P is quite high, right? At that point, mostly if you look at any of the steel stocks for that matter, today they are available at very, very reasonable or very cheap P's, but stock price has not been performing for a while now. In comparison, if you see till about 9 or 12 months back, when the P was quite high, the stocks were still rising, which means that P is nothing in fact but the market's expectations of how the company's earnings are likely to grow. Higher the P, it means that they expect the earnings to grow faster.
Yeah, I mean, clearly there is no one size fits all, argument with PE. I mean, this is something, it's basically one tool to help you make a decision. It's not the only tool. It will never be the only tool when it comes to investment, and that is the reason you have so many opinions in the stock market. And I hope that we have answered your question, and with that I think we should wrap up the show.
Well, it's a wrap, and thank you for watching, and please do share your comments in the feedback section below.
And as usual guys, keep following us on the social media links at the bottom of your screen, and for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live at 3 p.m. with all the day's action. Till then, hopefully you guys will have a great trading session.